FAR.F2.M7.
So Jenna, we've spent a lot of time talking about US GAAP. It almost starts to feel like GAAP is the only language accountants are allowed to speak.
That's exactly why this module exists, Russell. The FAR exam wants you to recognize that financial statements don't always have to be prepared under US GAAP. There are situations where another framework is perfectly acceptable, depending on who the financial statements are for.
Which sounds suspiciously like someone saying, there are exceptions, right before making me memorize 27 exceptions.
Fortunately, not this time. The idea is much simpler than that. This module is really about understanding why different reporting frameworks exist and when they make sense.
Okay, I like where this is going already. So what's the big picture?
Think of accounting frameworks like different maps. Imagine you're driving across the country. A hiking trail map, a subway map, and a road atlas are all maps, but they're designed for different users. None of them are automatically wrong. They're just built for different purposes.
That's a great analogy. And it explains why you wouldn't complain that a subway map doesn't show mountain trails.
Exactly. Likewise, not every business needs the full complexity of US GAAP. Some businesses prepare financial statements primarily for tax reporting. Others prepare statements for a local bank. Others just need financial information for owners who already understand the business.
So before asking which accounting rules, we first ask who's going to use these financial statements.
That's the mental model for this entire module.
Now Becca introduces something called special purpose frameworks. That sounds much more intimidating than it actually is.
It usually does. A special purpose framework simply means financial statements prepared using a framework other than US GAAP.
So we're leaving the GAAP highway for a little while.
Right. But don't think of these as sloppy accounting. They're still organized frameworks with their own rules.
The outline specifically mentions OCBOA.
Right. That's an important acronym.
And every CPA candidate immediately forgets what it stands for.
Other comprehensive basis of accounting.
Which sounds like someone couldn't think of a shorter name.
Probably. But remember what Becker emphasizes. OCBOA includes financial statements prepared using the cash basis, the modified cash basis, and the income tax basis.
Notice what's missing.
Exactly.
GAAP isn't part of OCBOA because the whole point is that these are alternatives to GAAP.
That's an easy exam trap.
So let's start with cash basis accounting.
Cash basis is exactly what it sounds like. Revenue is recognized when cash is received. Expenses are recognized when cash is paid.
Simple enough that even someone outside accounting can understand it.
Which is one reason many small businesses like it.
Here's an analogy. Imagine your personal checking account. If your paycheck hits today, you feel richer today. If you pay your rent tomorrow, you feel poorer tomorrow. You don't stop and ask whether the work happened last week or whether next month's rent is really paying for future housing.
That's a perfect way to think about cash basis. The bank account drives recognition. But here's where the analogy starts to break down. Businesses often need financial statements that better reflect economic activity instead of simply tracking cash movement.
And that's where accrual accounting enters.
Exactly. Revenue becomes tied to when it's earned. Expenses become tied to when they're incurred, not simply when money moves.
This is one of those moments where candidates should slow down. They're not memorizing two definitions. They're comparing two completely different philosophies.
That's an excellent way to think about it. Cash basis asks, when did money move? Accrual basis asks, when did the economic event occur?
Those questions often have the same answer, but sometimes they're months apart.
Exactly.
The outline also talks about modified cash basis. Whenever I hear modified, I assume someone couldn't fully commit to one idea.
That's actually pretty close. Modified cash basis starts with cash basis accounting, but incorporates selected accrual concepts.
So it's like starting with vanilla ice cream and adding a few toppings instead of ordering a completely different dessert.
That's a useful analogy. Just remember the limitation. The toppings don't suddenly make it GAAP. It's still fundamentally a cash basis framework with certain modifications.
Which means candidates shouldn't overthink exactly which modifications exist. The important takeaway from Becca is recognizing that modified cash basis sits somewhere between pure cash accounting and full accrual accounting.
Exactly. Understand the concept more than trying to invent rules that aren't in the module.
Then, there's income tax basis. This one seems almost self-explanatory.
It is. Financial statements prepared on the income tax basis follow the accounting methods used for tax reporting rather than U.S. GAAP.
So instead of asking, what does GAAP require? You're asking, what does the tax code require?
Exactly. Different objective. Different framework. Different users.
I'm noticing a pattern. Every framework answers the same overall question: how do we present financial information? But each framework serves different people.
That's the mental map Becker wants you to build. Don't memorize isolated definitions. Understand why these frameworks exist.
Now the module shifts toward converting cash basis statements into accrual basis statements. That sounds more intimidating than the previous section.
Conceptually, it's straightforward. Imagine someone hands you financial statements prepared on the cash basis. Now another user needs accrual basis statements. Certain adjustments have to be made.
So we're translating from one accounting language into another.
Exactly. That's probably the best analogy yet. Both sets of financial statements describe the same business. They're simply speaking different accounting languages.
Now Becker gives us a nice comparison table. Let's not memorize the table. Let's understand it.
Absolutely. Revenue recognition is probably the biggest distinction. Cash basis recognizes revenue when cash is received. Accrual basis recognizes revenue when it's realized or realizable and earned.
That's a phrase candidates hear constantly. Realized or realizable and earned. Don't just repeat it. Ask yourself what it's trying to accomplish. It's separating earning revenue from collecting cash.
Exactly. Likewise with expenses. Cash basis waits until cash leaves. Accrual basis recognizes expenses when they're incurred or when the benefit is received.
Notice something interesting. Cash basis focuses on money. Accrual basis focuses on economic activity.
That's probably the single biggest idea in this module.
Let's use another analogy. Suppose you're keeping score in a basketball game. Cash basis would only update the scoreboard after the referee officially files paperwork at the end. Accrual basis updates the score every time someone actually makes a basket.
I like that. The game itself determines the score, not the paperwork afterward. Similarly, accrual accounting reflects the underlying business events instead of waiting for cash.
Of course, the analogy breaks down because basketball doesn't have receivables.
Thankfully. Otherwise, accountants would probably become referees.
Now let's talk about why someone would bother converting cash basis statements at all. If cash basis is simpler, why not just stay there?
Because different users need different information. A lender, potential investors, outside stakeholders. They often want financial statements that reflect economic performance rather than just cash movement.
So, simplicity isn't always the goal. Sometimes usefulness is.
Exactly. Remember the map analogy from earlier. Sometimes the hiking map is exactly what you need. Sometimes you need the road atlas. Neither one is universally better.
I also think this module connects nicely with everything we've already studied. Revenue recognition, adjusting journal entries, subsequent events, fair value. Those topics all assume accrual accounting.
Great observation. That's why this module appears where it does. You've already learned the accrual framework. Now Becker is stepping back and showing that other reporting frameworks also exist.
It's almost like zooming out after studying individual trees to finally see the forest.
Exactly.
Now, let's hit a few likely confusion points. First, special purpose framework does not automatically mean incorrect accounting.
Correct. It simply means a framework other than GAAP.
Second, cash basis is not bad. It's simply designed for different circumstances.
Exactly. Different objective. Different users.
Third, modified cash basis isn't the same as accrual accounting.
Very important distinction. It starts with cash basis and incorporates selected accrual concepts. It doesn't become full GAAP.
Fourth, Income tax basis follows tax reporting rules rather than GAAP.
Correct. Keep asking yourself which framework you're operating under.
And finally, if you're converting statements from cash basis to accrual basis, you're translating between frameworks instead of changing what actually happened in the business.
Exactly. The business didn't change. The reporting language changed.
That's probably my favorite takeaway from this module. It's not about creating different realities. It's about presenting the same reality through different accounting frameworks.
That's beautifully said. And it's exactly the kind of conceptual understanding that makes exam questions much easier. Instead of memorizing isolated rules, you're asking, what framework am I using? Once you answer that question, many of the remaining decisions become much more intuitive.
Let's finish by revisiting our mental map. Framework first, user second, recognition rules third.
Special purpose frameworks include OCBOA. OCBOA includes cash basis, modified cash basis, and income tax basis. Cash basis focuses on cash received and cash paid. Accrual basis focuses on when economic events occur. Modified cash basis blends cash accounting with selected accrual concepts. Income tax basis follows tax reporting. And converting from cash basis to accrual basis means translating financial statements from one framework into another.
That's one of those modules where the concepts matter much more than memorizing dozens of journal entries.
Exactly. If you understand why each framework exists and who it's designed for, the details become much easier to organize.
Which is a refreshing change from some of the earlier FAR topics.
I'll definitely take it.